preparing.
Okay.
Ah, I can't see the recording starting there.
Someone
Okay,
has to.
yeah, you can go, you can go.
Okay. Good morning to everyone. Glad to see so many participants today. I'm Yumna Gata, and myself and my colleague John Yamunda will be taking you through a revision class for Investment Management 2601 in preparation for the exam. I think you're going to enjoy this class, and it's going to be quite beneficial in the preparation for the exam. You can go ahead, John. Okay. So before we start, apart like normally closer to the exam, I get 50% emails, personal emails on questions or like sections people are struggling with, but mainly people are asking for this admin information, right? So your exam is on the 29th of October, right? And Mr. Batsoma has written down a very nice exam information. You just have to read the entire document and you print it out and refer to it, because then you can be sure of all the information. You don't have to don't have to ask anyone to reassure you. The time, it opens up 15 minutes before, so 8 o'clock is the official exam time. It opens up at 7:45. The duration is 2 hours 30 minutes, not longer than 2 hours 30 minutes. You only get one attempt, so it's like a normal exam, right? The proctoring, they will be invigilating using the proctoring app. So the Proctor app, if I remember correctly from last semester, it takes pictures of you all the time so that you do not engage in any plagiarism. And then there's no formula sheet because you need to memorize the formula. It's part of the syllabus. And the content is 40 multiple choice questions. It's only multiple choice, no written questions. And it's based on study unit 1 to 14. Every unit will be tested. There's a combination of calculations as well as theory. And up to now, we haven't done any theory questions, but in today's revision class, we will give you a few theory questions to prepare you in that respect, right? And then the only recipe for success is you got to put in hard work. You got to be dedicated, and you got to practice. If you practice in investment management, you are guaranteed a distinction. Practice makes perfect. Okay, so that's my advice to you. And exam information, you can keep this clipping. I expect to have had everything clarified for the exam now. Okay, we can go to the next slide, John.
I was talking while I was on mute. That was not good.
Oh, okay. Sorry.
Okay, I was saying just so that is clear. I saw Bonani as a question there. This is
Yes,
our last class, yes, and the recording is going to be posted in the usual place. Remember, on my UNISA, I created a page with all the recordings.
yes, it's
So I'm going to post it as a recording below all those other recordings to make it easy for everyone. And if you are really dedicated, if you are struggling, the other thing you can also do is look through all the material we posted. But we also did all the difficult concepts in this module. All the difficult concepts are in some video somewhere where we talk through and work through an example, which you can look at and emulate. I think that will help a lot because I like during the week, I got a few questions where people were asking me, and I go back and I check, there's a video on the same thing. And actually, in one instance, it was exactly the same question I used in the video. There was a question which was sent to me. Look at that. You can send us emails, yes, but also make use of that. Okay. Back to you, Yumna.
okay. So yeah, the videos, it's like coming to a live class. Please make use of them. So we start off with the investment setting, right, which is your study unit 1. So we're setting every unit here in investment management builds on each other, right? So let's get started with study unit 1. Today we are going to do our explanation via a question. And let's start off with the first question. You can put your answer in the chat, which is your first theory question, right? So which combination gives the correct steps that should be followed by a portfolio manager while creating an investment policy statement during the investment process? Number 1, selecting a portfolio strategy. Number 2, establishing investment objectives and constraints, measuring and evaluating performance, selecting assets, establishing investment policy. So which one would you do first and which step next and to the end? If you choose, you can please choose the correct combination and then we can move on to the answer, right?
I used to not like these questions, Yumna.
These are always confusing.
Yes, they
Yes.
used to confuse me. And I always preferred the calculations because they had a definite answer.
Yes, yes. No, in multiple choice, the theory is a bit more challenging than the calculations, because in the calculations they give you the exact answer, whereas
Yes.
in the
And
theory,
if you miss it, you'll know that the
yes,
answer's not there.
yes. But luckily, this one here, I mean, this is the first unit of investment management. So you, as the portfolio manager, what is your process? So try to just think with a clear mind, and you think, okay, first I do this, then I do this, then I do that. Sometimes it does get a bit confusing in between, but be confident and try and choose the best combination. Don't let it confuse you and then it throw you off for the rest of the paper. So,
And Opa has already posted something.
okay, let's read the chat here. Option 3.
She said option 3. And ladies and gentlemen, we will wait for quite some time till we have about 10 people responding, because this is a multiple choice. So you can, if it becomes too confusing, you can always use my foolproof approach.
Okay, John will give you his approach.
My foolproof, ladies and gentlemen, okay. If you are struggling, this is for you. If you already have the answer, please post it. If you are not finding the answer, I'll give you a foolproof approach. So, you see, my mother wanted me to go to school. So, my mother being my mother, I would say, my mother told me to choose this one. So, in this case, it's option 4. But the only problem is if I start from the bottom, let's see. My mother told me to choose this one. Okay. My mother changed her mind. So it's now option 3.
Okay. So it looks like they're going with your approach, Sean.
Yeah, but my mother, I think, would start from the top.
Yeah. So sometimes luck can get you through.
Okay. We have a few more. Okay. Now people are participating. That's a good thing.
Okay, no, that's a good thing.
Okay. Should we move on?
Yes, please.
Oh,
Okay.
and people are brilliant.
Okay, so option 3 is the correct answer. Just to go through it very quickly, because we have a lot of questions to go through. So the first option 3, the first thing you do is you establish your objectives and constraints. What would I like to achieve? What is my budget? Constraints are all the limits that you are in, and what do I want to achieve, right? The next step would be establishing an investment policy, using these objectives and constraints to draw up your investment policy. So we stick to that. Thereafter, you would get your strategy. How am I going to achieve these objectives? What is my strategy? What steps will I follow? Thereafter, you'll select assets based on this policy and strategy. Thereafter, you will measure and evaluate the performance of these assets based on your objectives and constraints, right? Now we go to the calculation in study unit 1, which you're most likely to be tested on, is the value of Rati Limited's share 5 years ago was 165 Rand. Today the share is worth 264 Rand. Calculate the annual holding period yield, right? So we start off by calculating our first yield, right, which is our holding period yield, right, where we don't take into account compounding of interest. It's a simple calculation. Step 1, you start with holding period return, where you take the ending value of the investment, which is given to us, right? Today, it's worth 264 Rand. You put it over the beginning value of the investment, which was we bought for 165 Rand, right? So we get 1.601. Now, it was 5 years ago, so we have to account for time, right? So we say to the power 1 over 5 to get our annual HPR. Annual HPR is your HPR to the power 1 over n, right? So 1 over 5 is equal to 0,2. When you input that into your calculator, right, you get 1,0986, right? Then you have a formula for annual HPR, which is your annual HPY, which is your HPR minus 1 to get your percentage form. So in this case here, after you subtract 1, it will be 9.86%, right? Simple, the simplest of calculation. You just got to remember the formula, substitute it in, and get the correct answer, right? Not too complicated. Here's a nice practice question for you. We have put the formulas there, but it's not a difficult one. It's a good starter.
Yeah, it's a warm up.
A nice warm up, right? And make sure you know this calculation, this formula. It's easy. It's an easy mark you can score, right? So an investment cost 13,530 Rand at the beginning of the investment period. After 5 years, it's worth 18,345 Rand. Calculate the annual HPY of this investment. So you can get started with this. Start with your step 1 HPR, then your annual HPR, and then your HPY, right? We've put all the formulas in for you. We look forward to seeing your answers.
Okay, I'm putting a break in the chat so that we know when the answers are coming, we know that this will be for HPY.
Okay, that's great, because our entire lesson today is only examples and questions.
Example questions, yeah.
Okay.
And we will try to start with an example, and then we give you an example, then we ask you to do a question, something like that.
Yes, we already have a response from Ruan. Well done.
That's good. It's looking good.
Okay, at least I'm seeing some nice confident.
Which means we're getting closer to the exam, and some people are ready.
Yeah, no, I'm glad. We weren't seeing much of this in the rest of the classes, so it's quite.
Yeah, in the previous class, the last class was the worst.
Yeah,
the technology wasn't working. People were disconnected. They were not in the class. But today looks like we are in business.
Everybody's engaged.
Okay, ladies and gentlemen, let's have more answers. Okay, let me check how many people we have. 22. So we are waiting. Before we start calling up names, let's wait.
Okay.
So how is the weather like there in Gauteng, Yumna?
Gauteng. It's not too bad, eh? We had some lovely rain. So it wasn't really storms, but we had some lovely rain in the week. But now it's very hot again, hey? Oh. And how is it on your side?
It was raining it rained a little bit last night, and it was drizzling a short while ago. So yeah, beautiful weather today. Yesterday it was boiling.
Okay, so today you have some nice weather.
Oh, some nice weather. Some really nice weather.
Yeah, no, it's been really, really hot, but this week we've had a cooler week, and I'm very grateful for the rain. We had a lovely downpour.
Okay, yeah, which helps. And if you have plans, then they'll start to at least.
No, definitely. We were waiting for this. It was too hot, and yes, it was. It's quite good.
Okay, some responses coming through.
Okay, so we
Okay,
got an
let
answer.
me count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Let's wait for maybe if we have 11 or 12, then at least we know that more than half the people have participated, have said something. We have, ladies and gentlemen, for those who have finished calculating, we have like 100 and, how many, 100 and what, Yumna? 100 and, let me, I'll tell you.
104 participants were last when I checked.
No, okay, but how many slides do we have?
Oh,
128 slides.
so we,
Ladies and gentlemen, we're going to do 128 slides in 2 hours.
John is going to let you guys do.
Okay, let's move on. Okay.
Okay, all right. So let's look at the answer, right? So we had step 1, we calculate our HPR, ending value of the investment, which is 18,345 over the beginning value of the investment, 13,530. You get the answer of 1.3559. Have a look at your step C where you went wrong, right?
Yeah, but
Step,
most of them got it right, Yumna.
most of
So,
them got it right. The ones,
brilliant people.
yes, very good. And then you go annual HPR, you put your answer in step 1 to the power of 1 over 5, which is 0.2, right? And you get 1.06278. You subtract the 1 in the front to get your annual HPY, which is 6.278%, right? Very simple.
It's very simple.
Most likely to be have a question like this in the exam where you'll be asked to calculate HPR, HPY. Please be familiar with it, and you've already scored yourself a point.
And if you're not sure, ladies and gentlemen, you can ask a question in the chat, but I can see this one we're still doing very well.
Okay.
Okay.
So our next session is investment theory, right? So we build up um, from your HPY, you go on to the next section where we use the CAPM formula to assess return, right? So we use the CAPM formula to assess return. And let's start off with the first theory question in this section. And it's the efficient frontier, right? So this CAPM formula is based on this efficient frontier. And the efficient frontier represents only portfolios, a portfolio of risky assets, a set of portfolios with maximum expected rate of return to a given risk, single assets. So please choose the correct combination of what an efficient frontier represents. And put your answer for me in the chat.
Okay. Lechaba is posted.
Okay. Getting
Looking
some
good.
prompt responses here, hey?
If we move faster, ladies and gentlemen, we will cover more ground. If we move slowly, then we are unfortunately stuck. There was a lecture, Yumna. There was one lecture where we covered maybe 22 slides.
Wow, okay.
I wasn't happy, you know me.
Yeah.
I'm driven results guy. That's my problem.
You have to stick to the form, minimum of 30 slides. What is your minimum?
Yes, 30 slides.
5 minutes a slide.
22, it says to me, maybe we
Yes.
did maybe 5%, which is too little. Okay.
It's too little. Yes. Okay. So we have a good response.
We got a good response.
Option B.
There's all of them are saying B. And 100%.
Okay. So basically, a efficient frontier doesn't represent single assets, right? It's
So
always a portfolio of assets, right? So that's your clue. Single assets are not included, right? So very well done.
Well done. Should we move? Okay, there we go.
Right. So let's go to our CAPM formula. So like I was trying to prepare you guys, each section is a build up of each other, right? So here we'll be doing a calculation using the CAPM formula along with HPR, right? So we have this example. Global Limited expects its share price to rise from 100 Rand to 110 Rand over the next year. The beta of Global Limited is 1.5. The return on the market is 13% and the risk-free rate is 9%. Calculate the required rate of return using the CAPM formula and determine if you will purchase the share, right? So investment management is about calculating, but also being able to understand what you're calculating, right? So this is how we calculate this answer. We calculate the actual return. We're expecting the share to be 110 Rand, which is the beginning value of the investment, over the ending value of the investment to 100 Rand, right? Which is expected to be 10%, right? Now we calculate the required rate of return.
There's a mistake here. There's
Yeah,
a mistake here.
Yes, yeah. So
There's
it's
a
supposed to
mistake
be the
here.
other way around.
Ending, but the formula there is not looking correct.
Yes.
Okay.
Ending value over beginning value.
And that was slide number 12. I could see you were doing a big calculation in your head.
Sorry. Okay.
Okay, let's just fix that.
Okay. Thank you, John. All right. So it's ending value over beginning value, which gives us 10%, right? Now we calculate the required rate of return using the CAPM formula, right? The CAPM formula is a simple substitution. You say your risk-free rate plus 1,5 multiplied by 13, which is the return on the market less the risk-free rate. Once you solve for that, you'll get 15%, right? Our interpretation on this is the estimated rate of return is 10%, which is lower than the required rate of return, right? Which means the share is overvalued, right? When the share is overvalued, we sell the share so that you can get a good price, right? You can get a good price when it's selling high. If it's a good time for you as an owner to sell, right? If it's undervalued, it means it's selling cheap. So we buy when it's undervalued. When something is on a special or selling under, we buy. But in this case here, it's overvalued. The required rate of return is more than the actual return. So that means it's overvalued and we will sell the share. It's a good time to sell. You can get a good price. So a very similar question for you guys to do using the CAPM formula. You believe the share of Brownstone Limited has an estimated rate of return of 20%, right? The beta of Brownstone Limited is 0,8. The expected rate of return on the market is 12%, risk-free rate 8%. Calculate the required rate of return using CAPM and determine whether you will buy or sell, right? So in this case here, like you are given the estimated rate of return. Now you will calculate the required rate of return using the CAPM formula, and then you will tell me based on your answer, what will you do, buy or sell the share, right? So you can go ahead with this question, right?
Okay, let's put a break in the chat so that we know when the car. Now, actually, these ones will be numbers, so we will. So your answer will be 10% sell, 5% sell, 5% buy, 20% buy, or something like that.
Yes, thank you, John, for that. I think we're moving along nicely.
We are moving along. Angelique.
Yes, we are getting to. Okay, so we have an answer already.
And Ruan, okay. Undervalued, okay. Ruan and Angelique, they've taken the lead. And they are agreeing. Iopa give us what is the number, what is the expected return using your capital asset pricing model? Centel, Lechaba, Hamahelo. Things are looking good. Things are looking good.
Yeah.
1, 2, 3, 4, 5, 6, 7, 7. We need Ezekiel. Where is your post? You can't just go without starting a fight with someone, Yumna. We need to start
John,
fights with
look
people.
at how well everyone is doing today. Just give them the credit.
Mr. Nesengane, don't see your post here.
There we go, Mr. Nesengane.
Okay. I think he saw that I was coming for him.
Yes, you're putting pressure, John.
Let's pressurize people. Let me look for someone. Let me look. If you keep on looking at people posting, and I'll go and check. C Van Zyl. Are you seeing C Van Zyl saying anything there?
Van Zyl. Let's have a look. Nothing here.
Nothing. C Van Zyl. But C Van Zyl always comes to the lecture. But yeah.
There we go. It's a CV. Is it CV?
Okay, yeah, I see. Okay, I can see now he posted.
There we go.
Pumza. Did Pumza post anything? Nothing. You can't see the Pumza. Okay. Pumza. Did you shout at Pumza today? Not yet.
Okay, but we got a good response here.
Okay, so we should move on, I think.
Yes.
I think we should move on. Okay. There we go.
All right. So what we do is we calculate our required rate of return using the CAPM formula, and you get 11.2%, right? Well done to everyone for that. So the estimated rate of return is greater than the required rate of return. Therefore, the share is undervalued, right? Opposite of what happened previously. Hence, I will buy the share. Selling cheap at the moment, so I'm going to buy the share, right? So that's a good interpretation.
Okay.
To conclude this section, we do one more theory question, which is the capital asset pricing model links together return and total risk, or does it link together undiversifiable risk and diversifiable risk? Undiversifiable risk and all the return, the market return and all traded securities. So please choose the correct option of what does the capital asset pricing model, the one you use now to calculate return, what does it take into account? You can put your answer in the chat.
I'm looking at the question nicely, Yumna. Because I just was fiddling with the slides. I wasn't looking at them closely.
Okay.
Okay, so I will go with my mother's option instead of so my mother told me to choose the option 2. Keep
Option
that in
2.
mind. Option 2, that's my one.
You know, the thing is about the theory. If you practice enough, generally the theory are very similar type of questions, you know.
Yeah, exactly.
Like I've seen this question a few times. You know, you must know your work, that's for sure. But generally, you know, if you're doing multiple choice in theory, it's always good to practice on a question. So, and the similar questions are being asked, you know, so.
Why am I having some feedback there? Okay, there's no. What I wanted to tell the ladies and gents we have today is we are going to share the slides, and we have about 130. How many were the slides, Yumna?
Yeah, it was something around there.
Okay, let me look at an exact number. We have, I can't even count slides anymore. 128 slides. And so we are looking at about 70 questions. Most of these questions, we looked at some past exam papers and took the questions and put them there. So it's not like we sit down and just write these questions from nowhere. No, we are looking at past examples. So when we send you this, we think we are giving you enough practice if you go through all the slides. But no, we can't do that in this lecture because we don't have enough time. Okay? Oh, so lots of people were agreeing with me, Yumna, about with me and my mother. Option
Let's have a
2.
look.
Okay, let's look.
Okay.
Oh, me and my mother were wrong.
So yeah, it's undiversifiable risk represented by beta and all the return, because you are calculating return and you take into account the market return. So look at the CAPM formula. It's not only about risk. It's not a calculation of risk like standard deviation. It's a calculation of return based on beta, which is your which is your undiversifiable risk. So that's how to remember the components of the CAPM formula. Okay, so now we move on to valuation. So now we've calculated return and we've evaluated assets using return. Now what we need to do is do some valuations of assets, right? What are they valued as in price, right? So John, we're sitting with a solution here. Did I make a mistake?
No, you didn't. No, it's an example. Remember, we're
Oh,
doing
it's
an
an
example.
example. Okay.
Yes,
Okay.
so that the ladies and gentlemen are not too
Okay.
lost.
Okay. All right. So the first example we have is assume Gold Rivers Limited has issued 5 million shares and that the share trades at 22 Rand on the JSE. The firm's assets amount to 95 million Rand and the liabilities amounts to 2.5 million Rand. What is the net asset value of the shares? So basically your net asset value is equal to your total assets, right? Less your total liabilities, right? That gives you your net asset value, right? So remember the business is divided between assets, liabilities, and equity. So once your total assets less your total liabilities, you're left with equity. So that's the value of your shares. Then you take that amount, which is in this case here 95 million less 2.5 million, very healthy company, and you get the answer, which is 92.5, right? Divided by 5 million shares which are issued, and you get the answer of 18 Rand 50 per share. Simple, right? But you must understand what's going on here. Your equity divided by your number of shares gives you your value of your share, right? That's the net asset value formula, right? So let's try and attempt. Firewall Corporation has 6 million shares. The firm is trading, the firm shares are trading at 7 Rand 25 each. The firm's assets amount to 50 million and liabilities 20 million. Investment trust companies such as these normally trade at a premium of 30% to net asset value. Calculate the net asset value and determine whether you will buy or sell the firm shares. So this is a simple calculation but requires a good level of understanding. Please attempt this question and put your answer in the chat.
The good level of English, Yumna.
English, okay. So at least my English is doing okay now. Yes, yes.
It's a
I
good
can't tell
level.
you that
Yeah.
it.
Okay,
Oh, here we go.
I'm just neatening so that people, when people are struggling, they are not struggling with not seeing the question.
Okay, that's great. Thank you, John, for that.
This is slightly more difficult than the example we gave.
Yes,
Slightly.
yeah, but not. It's a
Not too
good.
much.
Yeah, this is the level you'll be generally tested on, as opposed to the one we gave in the example.
Oh, Lechaba already has an answer there.
Yes, lots of people have answers already.
That's
I think I did see. Yeah. Oh,
Lechaba already has an
okay.
answer.
Yes. Oh, that's Lichaba. Okay. But this is I enjoy questions like this because it's very relatable. It's a true story.
Yes. Okay. Melissa also has an answer already. That's good. Looking good. Refilwe. Refilwe is an answer. Let's see. Should we start harassing people or should we give them some time?
I think people are doing good
Oh,
job.
they are doing fine. They don't need some
Yeah,
harassing.
no, not today. Today is not a harassing day. Previous lessons I would condone it, but today,
No, today they don't need the harassing.
yeah, just proud.
When I was in school, if I had a bigger stature, probably I would have been a bully. But the problem was I was a tiny boy. I was a short boy. So, no chance to harass anyone. So now I get my chance, and you're trying to prevent me from bullying people.
Guys, you'll have to accommodate John.
I'm trying to catch up on the opportunities which I missed.
Yes, making up for it.
Yeah, I was a short boy. I'm those children who just grew tall in their 17th and 18th year.
Is it? Wow.
Yeah, all the other time I was just this short boy and nobody was looking at me. And then I got a little, not very tall, just a little taller. Okay, let's see. Looks like, we have lots of answers. Should we move on?
Okay, yes.
And
okay. So we have a good answer. So we work out the net asset value is equal to 5 Rand a share, right? And it's 7 Rand 25 less 5 Rand, which gives you 2 Rand 50 over 5 Rand, which is 45%, right? And they told us that the share normally trades at a premium of 30%. Now the share is trading at a premium of 45%. So what we'll say, we'll buy because it's undervalued, and we can buy because it normally trades at 30%. It's now trading at 45, or it's under by, wait, let me read it for you. The share is trading at a premium of 45% compared to companies trading at a premium of 30%. At the net asset value of 5 Rand and a premium of 30% regarded as the norm, the share should be traded at 5 Rand 60, not 7 Rand 25. So it's overvalued and we should sell. Yeah, that makes more sense. So the share is overvalued and we should sell. So you guys have to see here, when a share is overvalued, what do? We sell. Undervalued, it will be under 5 Rand 60, then we would.
That under and overvalued Yumna is confused.
It's very confusing.
It's very confusing. I used to increase the confusion when I was teaching face to face, to say when it's over, it's under. When it's under, it's over. That was my explanation. That was my whole explanation.
Yeah. Okay. So you can try
so
that.
If it's cheap, you buy.
That's the thing. That's for me, like, that's the only way I can say. If it's
selling
at a
cheap,
discount, you buy. Like you get a 20% off, obviously you buy.
So it's in this case, it's expensive because it's a 725 when you can buy it in another company for a much lower number.
Other companies in the same sector.
Same sector. Okay, Refilwe has a question.
Okay, Refilwe, go ahead.
I just wanted to confirm with you that if we get a question of this nature, can we also just take the process that you've just taken us through in terms of us understanding the valuation of whether to buy or sell? Is this the method that we would follow through instead of us just rushing into an answer?
Of course, this is why we're having the class, because like you first have to calculate your answer. Then you compare your answer to the information given in the question.
Yes.
And then from there you determine whether it's you compare your answer with the information given, and you decide whether it's overvalued or undervalued. Like we're saying, if it's selling at a discount, we buy.
Yes.
If it's selling at a premium, In this case, it's a premium, then we sell. We don't buy.
Okay, awesome.
Okay.
Thank you.
All right.
And also, as you can see, the answers will always be confusing. You can see there's 5 buy, 5 sell, 6.5 buy, 6.5 sell.
Yeah, that's what.
So yeah, that's what they are actually testing to, so that you know whether it's an investment opportunity or not.
Yes. Okay. So
Bonds.
now we move on to bonds, right? Which is, I think you'll get most, or like, from one section, bonds covers a lot of different sections, bonds and derivatives. So you'll get a lot of questions from this section with a combination of theory and calculations, right? So let's look at a theory question on bond risk, right? Which bond risk exposure entails the possibility of the issuer will fail to meet its obligations regarding the timely payment of coupons and principal, right? So what type of risk are we talking about here? When the person who has to pay for the bond doesn't end up paying, right? What type of risk? Like a person who has an account doesn't end up paying. That's what a bond is. It's like a loan. What type of risk are we talking about, right? Is it credit spread risk, default risk, downgrade risk, interest rate risk? Right, the answers are flowing in.
They are flying. Answers are flying in. How many people do we have? Let's look. Okay, we are looking good.
108.
Okay. Okay, no one to shout it. Looks like because people are
I
participating.
don't know how happy John is going to be after this lesson, guys.
Yeah, we'll be so unhappy. No chance to bully someone. Okay,
Yes.
so let's move on without bullying anyone.
Okay, well done. Default risk is the risk we're speaking about when you do not meet your bond payment, right? So
Okay.
that's the default risk. Not too bad, right? Now we have a simple bond valuation question, right? Calculate the value of a bond whose annual coupon is 10%, right? So it's annual and it matures in 3 years at the face value of 1,000 Rand. The yield to maturity is 8%. So now we're working out the present value of the bond. Our future value or face value is given to us at 1,000 Rand. The payment is annual, so you don't have to do any adjustments. 10% times the face value. That's how we work out the payment, right? I hope all of you have your financial calculators ready. Our period is 3 years and our yield to maturity is given at 8%, right? If you input all of this in the calculator, remember, no, in this case, you don't have to worry about your numbers.
Yeah, because they're not calculating your yield to maturity.
Yes, we're not calculating yield to maturity. If you input all of this into your calculator, you'll get the present value of 1,051 Rand 54 cents, right? So it's at a premium, and that's how you calculate the value of a bond. Very simple.
There's
right?
the exciting one.
Now here's a question for you. A zero coupon bond has a par value of 1,000 Rand with a maturity of 20 years and yield to maturity of 8% compounded semi-annually. Calculate the present value of the bond, right? So in this case here, you have a zero coupon bond. So what does that mean? We don't see anything about payment, right? But we have a yield to maturity given. We have a semi-annual compounding, right? So please account for all of that when working out the present value of the bond. Okay, sorry, John.
We are making good progress.
Okay, if you just excuse me for 1 minute, I just have to arrange something while they busy giving the answer.
Okay. Okay, I can see most of you are giving option 2. Okay, not most of you, the people who have posted so far, how many? 1, 2, 3, 4, 5, 6, 7. Okay, let's go, ladies and gents. so that we get to about 11 or 12 people. Ezekiel, I haven't seen your post. Pumza, let me first check. Okay, Pumza, I'm not seeing your post here. Okay, I wanted to call someone who had already. Okay, Opa already posted. Let's see. Refillway. Did you post the Refillway?
Doctor, I just need to be excused for 5 minutes. There's people outside doing maintenance. I'll be back. I promise. I'm sorry about that.
Okay, okay.
Okay, thank you. I'm back.
Oh, Ipumzari, you can, if you have your laptop, you can go to Excel and play around with these things. Okay, you're back, Yumna.
I'm back, yes.
Okay, should we move on?
Okay. All right, let's move on.
Yes, I was just holding forth.
Okay, thank you so
And most
much.
people know what they were doing.
Yes, they got the correct answer. Okay,
You maybe take them through why PMT is zero.
Okay, so it's a zero coupon bond, which means there's no payments in between, right? So the future value is 1,000 Rand. Your payment will be zero. Your period changes to 40 because it's a semi-annual bond. The compounding happens 40 times, not just 20 times according to the year, twice in 1 year. Your interest rate will move to half, right? Because for each period, it's 4%. And when you compute your present value, you get 208 Rand 29 cents, right? So you just got to input the correct information and you can compute your present value. You get 204. Right. Now for the more challenging question, which is actually, it's not too bad. We're going to look at bond duration, right? So bond duration is, let's look at the example. An 8% coupon, semi-annual 5-year bond with a face value of 1,000 Rand with a yield of 12%. Current price is 852 Rand 80 cents. Suppose the yield changes by 100 basis points. What is the duration, right? So we have all this information. The first thing we do, right? So you need to have a pen and a paper, a blank piece of paper in your exam. You draw up this table, right? You draw up this table. In the table, you put your period, which is your N, your yield to maturity, your coupon, your maturity value, and your price is what you're going to calculate at the bottom, right? So in this case here, we have an 8% coupon bond, right? So, and it's a semi-annual 5-year bond, right? So let's fill in the information at V0, right? Which is the information that is given to us, right? So they say it's a 5-year bond. So we times our 5 by 2 because it's semi-annual to 10 years, right? We have our yield to maturity, which is 12% divided by 2 because it's semi-annual, right? Our coupon is 8% times the face value, which is 80 Rand divided by 2, right? So we put it down there. Then our face value is 1,000 Rand, right? So we've put in all our given information. Now for our V minus and V plus, right? They say that it will change by 100 basis points, which means it will go up and down by 1%, right? So we say our yield to maturity is 12%. If it goes down by 1%, it's 11%. 11% divided by 2 gives you 5.5, right? So you need to make little notes of what I'm saying so that you remember where did I get 5.5 from, right? So put a little note next to V minus. Now let's work out V plus, which is your yield to maturity is 12%. We add 1% on there, which is 13%. Divided by 2 gives you 6.5%, right? As you can see, the rest of the information remains the same. The period is the same, the coupon is the same, and the maturity value is the same, right? Basically, the bond duration is seeing how does the price change when the interest rate goes up by 1% and the interest rate goes down by 1%, right? That's what we are trying to assess here, right? So now you input all this information into your calculator and you work out your present value at V minus, V0, and V plus. You will use these present values to substitute into the duration formula, which is V minus less V plus over 2 times V0 times by your change in interest rate, which is 0,01, right? So once you solve for this, you will get a duration of 3.9083, right? So that's your duration of the bond. So it's lengthy but not too complicated. So let's attempt a question here, right? We have bond duration, a 15-year, 10% semi-annual bond is priced at the yield to maturity of 11%. The yield changes by 150 basis points, right? So remember step 1, draw your table, put in your given information. In this case here, when you're accounting for your yield change, right, you're going to adjust your yield to maturity by 1.5%. From 11, it goes to 12,5. From 11, it goes to 9,5, right? And then you divide by 2. At this stage of investment management, very rarely you'll get an annual coupon paying bond. You always get semi-annual, so get used to dividing your yield to maturity, multiplying your period, right? So put all this information into your table. Once you get your present value, substitute into the duration formula given to you, and then you can choose the correct answer from the options.
Yes. And maybe let's just say, if you are stuck with anything, ladies and gentlemen, we are not here to do the 128 slides. We are here to say, if you are stuck, then we unstick you. If we move so fast that we get to maybe, let's say, 60 slides, oh, we'll be so excited.
Yes, but you know, we want this, like John is saying, stop and say, but how did you get this answer? Oh, but what do I do here? After you say those words, or after we explain it to you, you'll remember it even better, and many other students will too.
And also other people who are not asking, they will say, oh, okay, now that makes sense.
Yes. But there's a chat for the shy people. There's those who
are shy like me. Do you know I'm a shy person?
Know, maybe shy like me, yes, but not John. Lectures I attend, I wouldn't dare to speak, but the chat is there. It's a comfort zone, and I won't neglect to ask if I have a question, because that's why I'm attending a live lecture.
Oh, the end is up, Jacqueline.
Go ahead.
I just wanted to ask, where it says yield to maturity, I'm a bit lost there with the 11, how to get it. Yeah.
Okay. All right. So let me talk you through this. So you've drawn your table, right? So now we want to do V minus, right? So they've given us our yield to maturity at 11%, and they say it changes by 150 basis points. So we have to take 11% and adjust negatively, like subtract 1.5% from 11%, right? So if you say 11 less 1.5, right, will give you how much?
Jacqueline, she's asking so that she knows where you are.
So 11 less 1.5, simple mathematics.
11 minutes, 1.5 gives me 10.
What it gives you? 11 less 1.5?
It's 9.5, Jacqueline.
Why is it? Maybe it's my calculator. It's going
You
crazy
were
now.
supposed to calculate it in your head.
11 less 1,5. So 11 less 1 gives you 10. 10 less 0,5 gives you 9.5, right?
Yeah.
So it's a semi-annual bond. So divide 9.5 divided by 2, which must give you
Something. 4.75. But that's a guess.
John is a genius.
That's a guess.
4.75, that's right. So that would be your V minus, right? This is the step process you do. Now let's
Okay.
account for it positively, right? Positively is a little bit more easier. You say 11% plus 1,5, right? 11% plus 1,5 must give you,
12.5.
well done, divided by 2 gives you,
Oh, I divide that by 2.
you
Oh,
divide it
okay.
by 2 because it says semi-annual bond. So we earning 12,5 divided by 2 is 6,25. For each period, we're earning 6,25. That's how you calculate semi-annual bonds. You always divide your yield to maturity by 2. And you always multiply your period, which is 15 years, by 2, right? When you see semi-annual, you must adjust your period. Your period doubles, right? Because you're receiving interest twice a year, right? But you're not receiving 11% twice a year. You're receiving 5.5% in every 6 months. So that's what we got to understand with semi-annual means you're compounding twice a year. You're receiving interest twice a year.
I think she is ready now to calculate. Don't you think?
Okay. Okay.
I hope that helps.
It helped me.
Okay, John.
At least you have one person who benefited. Anyone else with a question for Yumna so that she can explain while you are waiting for answers to come in? Okay, I can see answers are coming.
Answers are coming. Okay.
Mr. Nesengane, are you doing fine there?
How do we calculate payment? So payment, you calculate
Yes.
per value, right? Which is 1,000 rand, and it's a 10% semi-annual bond. So you say 1,000 rand times 10%, which will give you 100. But you adjust for it to semi-annual. So you say 100 divided by 2. So because you're receiving 50 rand twice a year. Interest is receiving 50 rand in the first 6 months, 50 rand in the next 6 months. That's semi-annual.
Are you feeling lucky today, Yumna?
I was feeling lucky up until now.
No, okay. So do you think Steve and Zio is going to post something?
Please post for us.
I think let's put a how much do you want to bet?
Should we bet, John?
I think it makes it worthwhile.
Okay.
No, I think last time we betted on Steve and Zio, I think I lost. So let's bet on someone else.
Okay, so you can bet because then you owe me.
Okay, yes, okay. Let me.
Because everyone is very ambitious today.
Okay, Lynette, is there an answer from Lynette there? Lynette.
Let's look, Lynette. I don't see anything from
Okay, so
Lynette.
I'm going to bet that Lynette is not going to post 20 rand on that.
Okay, Lynette, come on, do this for me.
Lynette, please don't post.
Please, Lynette, post. Or at least respond.
20 rand in my pocket, Lynette is not going to post nothing.
Come on, Lynette, you can do this for me. I can't afford to lose anything at the moment. The week before payday.
Okay.
Lynette, yeah, she's putting anything. There we go, John. Thank you. I'll send you you have my cell phone
Yes,
number.
yes. I'll buy it.
Yeah, you can buy it. Okay.
Okay. So more people are posting. Maybe they don't want us to bet on them. Okay. Should we go? Should we move, Yumna?
Yes, yes, we can. Okay, so let's look at the answer. At least the answer we
Oh,
got.
did it go to option 1,
was-
2? Okay, okay, okay.
Yes,
I
well
really
done,
want your
Lynette.
money. You want
Sorry
your money.
for using you. You see, John, I have faith in this group.
Yes, okay.
Okay, so let's go straight to the table, right? So why is our N 30? Because it's a 15-year bond, but semi-annual, so we multiply 15 by 2 to get 30, right? We spent a great deal of time working out the interest rate with Refilwe, was it? So we
Yeah.
worked it out as
Jacqueline, you're Jacqueline.
with Jacqueline, 4.75%, 5.5%, and 6.25%, right? Stop me if anyone didn't get these amounts, right? But we did give a lengthy explanation on it. Our payment is 50 Rand because it was a 10% semi-annual bond, which gives you 100 Rand coupon per the year. Divide that by 2 for every 6 months, we receive 50 Rand coupon payments. The future value is easy. Once we input this in our calculator, we will get V minus to be 1,039.55 cents, V0 927.33, and V plus 832.45, right? So if you substitute this V minus less V plus on the top over 2 times V0 times by your change in interest rate 0,015, which is 1.5%, right? You will get option 1 7.4445. Okay,
Brilliant group.
great group. You know, last semester, if you remember correctly, John, you
Yeah.
had students explaining duration and convexity to us.
Yeah, that was
Yeah,
exciting.
that
was
was
exciting.
it was quite amazing, hey?
Mr.
So,
Nesengane is end up.
Mr. Nesengane, please go ahead.
Thank you so much. I just wanted clarity because
Yeah.
according to my calculations here,
Yes.
I got V plus S7, and then on the V minus I got 4 because I was adjusting my interest by 1.5. And I can see that it's different from your calculations. Can you clarify me once again, please?
Okay. So your yield to maturity is 11%, right? Let's ignore the percent for now, right? So we take the whole number 11, right? You subtract 1.5 from 11, right? You subtract 1.5 from 11, you will get 9.5, right? Then you say 9.5 divided by 2 because it's a semi-annual bond. And then what you do is you go on the other side. You say 11% yield to maturity plus 1.5 gives you 12.5. 12.5 divided by 2 gives you 6.25.
Are you happy, Mr. Nesengane?
Thank you so much. I can see where did I go wrong.
No, I'm so glad.
So convexity, it's going to be a breeze if you get this because it's very similar. Okay, convexity, you went on mute there.
Okay. Okay, so there's convexity, right? So example of convexity, the advantage of this is the table is the same, right? We just have to substitute the final amounts into the convexity formula, right? So let's look at an example. A 15-year, 10% semi-annual bond, which is the one we were doing, right, is priced at the yield to maturity of 11%. The yield changes by 150 basis points, right? So this is the one you've just calculated, right? And we got these answers, right? Now,
Yeah, they were in the table, yes.
yeah, so these are the, generally, you will get one question or one set of information, and you'll be asked to calculate duration in one question and convexity in one question, right? So it's because it's this from the same table you substitute into two different formulas, right? So you have convexity. The formula is V minus plus V plus, right? Less 2V0, right? 2 times V0 divided by 2V0 multiplied by your change in Y squared, right? So it's a little bit of a more complex formula. So how do you do this? You say V minus, which is 1039.55.
39.55.
Is there an echo here?
Yeah, one of your gadgets is also on. I think there's
Okay.
two things on the
Two
go.
things on. I actually just have one for now.
Okay. I don't know.
Yeah.
The
Sorry.
technology is unhappy with you
Sorry
then.
about that. And then you plus V plus, right? So you add your V plus, the bottom figures, the present values, you add them together, right? And from that you subtract 2 times V0, right? Which is 927.33. You solve for that. You put it over 2 times your V0, right? Times by, in this case here, we have the change in Y, which is 0,015.
0.15.
And
Yeah,
you
there's a
square.
mistake there.
Yes.
There's a
Because
mistake. It should be squared. You know that
squared.
superscript after 15 there.
Yes. So
I know what. Let me put a thing like this one, which is
ba-
easy to see. That one. Huh?
basically that 2 was supposed to be a square.
To the
on the
power
front.
of 2.
Yes, to the power of 2, right? So if you put 0.015 to the power of 2 in your calculator, you'll get like 0,00 something. You'll get an amount which has a lot of zeros in it. If one of you can try it on your calculator and put it in, then okay, there we go. Thank you, John. And then you will get the answer of 41.5399, right? So this is an example on convexity. It's a simple substitution into the formula. Just to clarify how you substitute into the formula, you do your addition less your multiplied brackets. And at the bottom, it's 0,15 squared times by 2 of 2 V0.
Okay, at least this one is I thought it was the same question. It's a different question at least.
Different question. Okay, so bond convexity, you have a 20-year, 15% semi-annual coupon bond, which is priced at the yield to maturity of 12%. Yield changes again by 150 basis points. Calculate the convexity of the bond, right? So here you're also adjusting for 1.5%. 1.5%. And you draw up your table, and then we can substitute into the formula. Okay, please attempt this question.
Yeah, I'm leaving you for a minute, Yumna. Oh, let's say, yeah, what is it, convexity? Let's put a thing in there, convexity.
Convexity, okay, yes.
So that we will know when the answers come, otherwise we'll start mixing them up.
Yes.
I'm running away from you for a minute.
Okay, perfect. Thanks, John.
You can talk to them nicely.
Okay. All right. I want everyone to talk to me, because generally the perception about duration and convexity is confusion. However, it really is not. Like I can really relate to you when you go into derivatives and this overvalued, undervalued, it gets a bit confusing. But these here, it's simple step-by-step processes to follow, and work on your accuracy in terms of calculating bonds. Do a lot of basic bond calculations that when you come to duration and convexity, which is guaranteed questions in your exam, you can it's guaranteed questions in the exam. You can do it well and easily. doesn't confuse you, you know. But what I'm noticing is that people are struggling, or lots of people are getting confused with the semi-annual, adjusting for semi-annual. And then the next part comes in to adjust for the basis points, right? If you're lucky, you'll get 50 basis points or 100 basis points. But just be prepared for all types of changes in the basis points.
I'm back.
Okay, John is back.
You didn't even miss me yet.
No, not too long. Thanks, John.
Were you telling them about basis points?
Basis points. No, yeah, I'm just saying I don't find convexity and duration, you know, it doesn't fall in the category of confusing calculations.
No.
So, you know, you've got to, and we are going to this, you are going to get questions on convexity and duration. So be well prepared with it.
And just to make it more realistic, you know, when the Reserve Bank increases interest rates, they usually say it increases the Reserve Bank increased the interest rates by 75 basis points.
Yes.
Now, when they say that, you're supposed to say, well, give me a break. I already know what basis points are.
Yes. So that's
The beauty of education. You start to know more things, to understand more things.
yeah. And it's a wonderful feeling, actually.
Yeah, it's a
You can
wonderful
relate.
feeling.
Yeah.
You can relate. And you sit in a presentation, people are talking, and okay, they are getting, everyone is like, they are sitting upright. Say, wow, I could as well give that presentation too.
Yes.
That was my feeling when I graduated the UMNA. So that people should know how beautiful it is to graduate your undergrad.
Yes, definitely.
Then there was someone was talking about standard deviation, variability. I say, wow, you're just playing around. We are right to understand that.
Yes. It could be.
And we are chasing portfolio alpha. I say, wow, portfolio
Okay.
evaluation. That's chapter 14.
Chapter 14.
Yes, that's where he is. But because I'm a shy person, I didn't raise my hand to say, okay, what formula are you using to evaluate which investment is performing better? No,
Okay.
I was shy. I was supposed to do that.
Yes.
You know, when asset managers are presenting, it's always interesting. They just show you, you know, we performed better than the investment manager A, B, and C. You see how good we are. We are number 2 or we are number 3.
Yes.
In my mind, I'm saying from investment theory, you are supposed to actually take into account the level of risk of your portfolio. But
So you see,
in education,
it's
this module which you are doing,
yeah. You know, the thing is that now everything is marketing, you know. Better
yeah,
performance gets you
yeah.
more attention.
So they give you solid numbers. You
Yes.
see, our fund did the 8%, theirs did the 7.5%. So
Yes.
ours is better.
Yes.
But from this module, we know that you can't measure performance that way because we need to take into
Performance, yes.
account the level of risk.
The level of risk, yes.
Then they say, yeah, but there are two balanced funds, but no, balanced funds are not exactly the same. The level of risk they're assuming is different.
Yes.
Okay. That is, if you want to be unpopular, ladies and gentlemen, that's what you do.
Yes. If you don't want anyone to buy into your fund easily, you
But
don't
if you want people to buy into your fund, you just market the top number.
Yes, just the
Yes,
line.
that's the top number. If you are, and then you have 3 balanced funds. So this year, if A is doing well, that's the one you market. Next year, if it's C doing well, that's the one you market. That's business. Okay. I think, should we move on? I think we have lots of answers. Option 3, option 3, option 3.
Okay.
Ah,
All right.
today
So
we have
option 3. Well done.
we have actually distinctions in the making, Yumna.
That's great. Yeah. If we on this level, John, then I'm happy. At least.
Yeah,
Students are,
people are actually very ready.
He really knows. Yeah, if you've done this well up until now, it's like
Yeah, I think
70%
you are
of the
ready.
paper.
With one more week, I think you are going to clear it. You're actually going to get a
Definitely.
distinction if you put your head down.
Definitely. You make the most of this week, and yeah, we were aim for a distinction, not
Aim
just
for a
pass.
distinction. Yeah, no, not a pass.
Okay, so just let's have a look here. The basis points will change to 5.25, 6%, and 6.75, right? So it's 12 divided by 2 for the V0. It's 12 less 1.5, which is 10.5 divided by 2. And then you get 12 plus 1.5, which is 13.5 divided by 2, which is 6.75, right? I'm just going to clarify the parts which I think that you will would be challenging. And then you would get your present value. Once you substitute into the formula, you do your addition first, right? Then you solve for the brackets and you subtract the 2, right? So once you solve for the brackets, you subtract the 2, which is step 2. The bottom one, because it's all multiplication, you can do it at one time. I would suggest you say 0.015 squared multiplied by V0 times by 2. And you should get the answer of 0.5516. Once you've solved for the subtraction above on the numerator, you will get the following answer, 44.9474. Right? Well done to everybody who got it right. Now let's look at some theory on bonds, right?
You just take a break from exercising your multiplication.
Yes, yes. Take a break and let's go work on our English and our reading.
Yeah, the English, yeah.
The English, that's the main thing here. And so look here, they're giving you an answer, they're giving you a clue. N or a yield curve, which type of yield curve is the one which the yield is on the intermediate term issues are above the yields on short-term issues, and the rates on long-term issues decline to levels below those for short-term issues before leveling out. Oh, this one is a tough one here. So this is the type of yield curve which is described by the above information.
Should I give them a hint, Yumna?
Yes, yes.
You saw the hint?
Okay. I don't know if everybody saw that, but
Okay, let's first part you say what yield gave me. First, let's break it so that people will know where we are. Okay, then I'm giving this is a big hint. Or the ladies and gentlemen,
everyone got the hint. Yeah.
this is gonna be a big hint.
Yes.
I already know the answer.
But it could be also downward sloping, guys. It could be it's going, you saw it going down afterwards. But please, this is not how we prepare you for the exam. What we're saying is go research yield curves. Yeah?
I was expecting the others to now come flooding, but they are not coming flooding.
They're not sure. They didn't realize you'll do that, John. They didn't
see the hint.
They're suspecting it. Yes. John is enjoying his pointer, guys.
Yes.
Yes.
Not anymore. I can't give another hint.
Yes, there we go. The answers are flooding in.
Okay, but if you are misled, Yumna, if I misled people, I don't know what I'm going to do.
Yes, you see.
Okay, should we move on?
Yes, research your yield curves. One second.
Yes, it's armed.
Okay.
Okay.
Okay, well.
There we go, equivalent yield.
Okay. So now the next calculation in bonds is your yield to maturity calculation, right? So we calculated the present value of bonds. We went to convexity and duration because it also included present value calculations. Now we will be calculating the yield to maturity, right? Calculate the yield to maturity and equivalent yield of SA Breweries bonds whose face value is 1,000 Rand. The current value, the present value is now given. Current value is 840 Rand and it matures in 10 years' time. right? And the coupon is 15%, right? So this is an annual paying bond, right? Just to get you started on how to calculate the yield to maturity, right? Our face value is given as 1,000 Rand and our payment is 150 Rand. How do we get that? We say 15% times by 1,000 Rand, right? So we want to, we've been given the present value. Now you see here in front of the present value, we change the notation. It must be different from future value and payment. So we put negative, right? So then only your calculator will give you the interest rate correctly. Otherwise it will say error. So make sure you take your, you change your present value to negative 840. We're paying, so negative, it's going out. Our period is 10 years, which is given. If you calculate the yield to maturity, you will get the answer of 18.6418%, right? Now, the next part of the question is the equivalent yield, right? So if you don't mind, John, can I ask you to explain equivalent yield, because I am not so good with it, as I think you would have a better understanding.
So the equivalent yield, they are trying to say how is this amount, because you can see this is an annual bond. If we were to say what is the equivalent yield if it's compounding twice, this is what they are trying to do here. Okay. What will it be? So they are saying 1 plus equivalent yield to the power is 1, that minus 1 times that. So you're just plugging that number and putting it there. Okay. And there, and there, and then you get that number. That's a good explanation.
Twice a year. Okay. Yes. So at least it's quite understandable. So you guys can also see how compounding twice in the year affects the rate, the yield to maturity.
The yield to maturity. Okay. Yes. Let's give them their question. I think it's this one.
Here's a question.
We didn't give a, I think no, was the Hindi necessary? Yeah.
Sorry. No. Okay. So here is a yield to maturity calculation. An investor has an 8% annual paying bond with a par value of 100,000. The bond has a market price of 88,401 Rand and is 25 years to maturity. The yield to maturity and bond equivalent yield of the bond. So you have to calculate these. It's annual bonds, and then you convert it to a semi-annual rate or a compounded twice a year rate. So please attempt this question and put your answer in the chat.
I was trying to find the answer without the calculation, but it looks strange. Let me see if our answer is correct there. Let's see. Let's see. Because if you look at the numbers, they don't look right.
They don't look like the right ones. Even the bottom ones, John.
But if you do the calculation, okay, let's see.
Yeah, it doesn't look right. You're right.
It doesn't look right. Yeah. The other one should be higher, as far as I know.
Yes. Left must be higher.
And ladies and gentlemen, don't worry about our worries.
Okay.
Because it may be, when we get to the answer, they'll be surprised it will be correct. -1. It's all right. It's all right. Actually, I did the calculation here, Yumna. It's all right.
Is it right?
Yeah, it's strange.
Okay. Right. Okay.
But maybe the top. Yeah, the answer solves. So the answer solves correctly.
All right. So I see where the answer is.
But it's strange. Okay, let me go back to the team so that I can see
Okay.
Oh, okay, you already put a divider. Okay, that's what I was. That was what I was rushing for. So, ladies and gentlemen, when you find your yield to maturity, post it in the chat, and then you calculate your equivalent yield. Remember, the equivalent yield is equal to 1 plus yield to maturity to the power of 1/2 minus 1 times 2 to annualize the number. Oh, That's clear. I can see it. So I'm even confused it myself. I'm confused myself.
Okay, we got an option 3.
That's Angelique. Sihle says option 3. You can actually just look and find an answer which is reasonable there. But when we were looking, it wasn't looking. That number wasn't looking.
Yeah, it wasn't.
It
but
wasn't.
I'm a bit worried about the suggestions which John is giving you guys in preparation of the exam. Just rather know your work, please, and study your work. And yeah.
Me and you and I have this philosophy, ladies and gentlemen. In case you don't know our philosophy, we try our best, but we say if we make mistakes, there are no consequences on our part. But on your part, there are consequences.
We just try our best to assist you.
Yes.
But as John says, we're not going to be examined.
And now, nobody. Maybe that's what we call that the one we were talking about earlier on, the feedback.
Yes, survey.
So the survey, yes, maybe the survey, maybe they are going to take a whip and say, you are not doing a good job, then they hit us. Who knows?
Oh, no. Actually, none of us have met even, so at least we don't have to consider getting beaten up.
Okay.
Okay.
We are left with 5 minutes. What are we going to do, Yumna? Should we show the answer and call it a day? And what should we continue?
I don't know if you maybe want to do 1 or 2 derivatives. I'm available, but I'm not sure about everyone else and you, Mr. Ron.
Okay, let's show the answer first.
Okay.
Then we can talk about that.
Okay. So the answer was that option 3 or option 2?
Yeah,
option 3.
Okay, yeah, but the 9% was correct.
9%, okay. So you put your calculation in end mode, right? Your future value is 100,000. Your present value, negative 88,401. Your payment is 8,000. Your N is 25. Your interest rate, you'll get 9.2%. When you substitute it in your bond equivalent yield, you get a 9% bond equivalent yield return. 1.092 to the power 1 over 2 less 1 times by 100 multiplied by 2.
Let's ask this question, Yumna. Should we do 2 questions on derivatives, ladies and gentlemen, or should we call it a day?
You can just put a thumbs up or...
So yes, no, no, yes, no, no, yes, no, no. Let's put in the chat, ladies and gentlemen. Yes, no, no, yes, no, no, yes, no, no. Because our...
Okay, so we're getting a...
Let's go. Okay, let's do derivatives. So we are going to just do 2 questions on derivatives. One on the... Okay. I always want to give a background when we should be moving.
Okay.
So 1 theory question. Ladies and gentlemen, okay, am I taking them now, Yumna? You're doing such a wonderful job. Am I the one talking?
Yeah,
now?
please, John. You can take over, then we know.
I'm so sorry, ladies and gentlemen. It's now my turn. I'm so sorry.
It's no, I think everyone's very happy.
We have to apologize before we start. Which of the following orders is most useful to short sellers who want to limit their potential losses? Make your choice, ladies and gentlemen. Make your choice. Make your choice. Make your choice. 1, 2, 3, or 4. You see now they are going to start ignoring me. They were responsive, but now gonna go back to quiet silence.
Respond in hope of getting as many questions, or like
So we are left with only 3 questions. This is one of them.
Okay, yes, that'll be great. Then at least we've covered a little bit of derivatives, and then I think we've done portfolio management was our last lesson, so that you should be okay with. And then the videos are just like a live class. You need to make use of the videos. I think they'll be highly beneficial to getting a calculation or any concept, to understand the concept, the videos are very good in that respect.
And can you see this slide, Yumna, slide number 39? Have you ever seen this in this class?
Yes. See, John, you're happy today. We moved very swiftly.
We
Our,
did a great
our
job.
goal for next semester.
We did a great job, Yumna. Okay, let's move on. Okay, ladies and gentlemen, actually it's a stop by order.
By order. Okay.
So actually stop by order. So ladies and gentlemen, if you get this question, which of the following orders is most useful to a short seller? Remember, short seller, someone who sells who sells assets they don't own. So it can be a stop loss because they don't have they are not holding the asset. They are selling assets which they don't own. Those are the short sellers, not short people, short sellers. Okay, ladies and gentlemen. Okay, let's do this question together. This is goes to the heart of options. Alexis bought a put option for R5 and the strike price was 55. Okay, so premium 5, strike price was 55. At maturity, the spot price is 49. Calculate the profit or loss of the put option holder. What is the corresponding profit or loss for the writer? Okay, so we can ignore what is the corresponding that one because I'll tell you why it ignore. So the first thing you need to make is a decision. Is Alexa's going to exercise the option? So we are told the strike price is 55. Strike price is the agreed price 55. Spot price at maturity it's 49. And this is a put option. So the final price is 49 is less than the strike agreed. So therefore, it's a put option. Therefore, the decision is to exercise the option. It's a put option. So what is the profit? Therefore, we say 55 agreed price. They are going to sell their asset at 55 minus 49, which is the spot price, minus 5, which is the premium. Therefore, their profit is going to be R1. What is the corresponding loss to the writer is R1. Any questions? Any questions, ladies and gentlemen? Any questions before you attempt your own one? Okay, let's write options here so that we know options. Okay, I'll just read to you so that we can spend some quality time together. A put option share A with a strike price of 60 is priced at R3, while a call with a strike price of 50 is priced at R4. What is the break even for the put option and the profit for the call holder if the share price is R80? Remember, break even is where the profit is 0. Profit or loss is 0. That's the break even point. So the question is, what is the break even for the put option holder? I won't give you more information, otherwise I will end up giving you an answer by mistake. Unless if Yumna wants to give you a hint.
No, I don't even have any hints which I can give you guys.
Okay.
But
So you're
because
only on.
No, the previous example gave you it's a good example to help you to start attempting this.
Yes, because this question which I'm giving you, ladies and gentlemen, it's more, look, I think we took it from a past exam question paper. It will come
Just
with
you're calculating both
yeah.
sides, yeah.
Yes. It comes with a little bit of confusing language. It sounds like a little bit more English and calculations. Okay, I'm hoping if these ladies and gents are fast, maybe by quarter to be all gone.
Yes.
And you are going
I think
to.
that's a good time that we can.
That would be a good time, yeah.
Yes.
We are not going to do what we call it. What do you call your favorite topic in derivatives? You know your favorite topic where you for futures, what do you call it? Where we account?
Arbitrage.
Yeah, exactly. That's your favorite topic.
Yeah, but arbitrage is not bad. Eh? It's you just memorize it. That I can still do, but
I only do it this time. People are tired.
yeah, no. Arbitrage we won't attempt, but look at the videos and look at our
Yes, there's
previous
a video on arbitrage.
lessons on arbitrage.
There's a
But
video on arbitrage.
yeah, these profit loss, it's simple. It's like English, right?
Yeah, English.
And yeah, so you just do it in that way. Just separate your question here, and then the put call parity as well. A nice simple calculation because it's a substitution into the formula. So
Yes, yeah. So that's why
yeah,
we're doing this one. These are straightforward
yes,
arbitrage. But there was a question. I had a question on arbitrage from one of the students. He sent me an email.
Yes.
Then I did a video on arbitrage. That whole thing story about futures and arbitrage. I was happy with it, but I don't know whether people were happy with it. But I was just happy with it. But you know me, I'm always happy with my stuff.
Okay, that's good. So you did a video based on a question from a student. You see,
Yes,
guys?
yes.
More questions, more inspiration. You get more material.
But if no one is asking questions, why would you do
then you'd
anything?
be very like. I often come on my UNISA. I don't I don't
Find any
see
questions?
find any questions. So I'm just lurking around on there, and I'll be like,
Yeah.
okay, people are fine,
And meanwhile,
then
when you're lurking around, the students will also be lurking around. So everyone is
I'll be
just
like, oh, let's hope someone posts some information and helps us out. No, that's not going to happen, guys.
But I think we could put good stuff on there.
Yeah, no,
I
especially
saw you gave you usually post some questions for people to practice, and then I post some videos.
yes.
I think I would like to think we will be delivering some good stuff there, but who knows?
Yes.
It's just us who think that.
Just,
But it's a good
results.
thing. It makes us stay in the game.
Yeah, no, definitely. Okay, so we have some option 4.
Some options. Okay, I will move on because I am sure people are tired. That's why it gets because once we are over 1.5 hours, people are really tired.
Okay.
So people are saying option number 4.
Okay.
What was option number 4? 60. Okay. So the break even. Let's put option. So what is the break even for the put holder? Okay, so let's look for the put. So the put is a strike price of 60, and it's priced at 3 rand. So the break even will be 60 minus 3, ladies and gentlemen. That's what gives you a profit of 0. Remember, break even is 0. So 60 minus 3, 57. That's why we have 67 there. So that's the break even. And what is the profit of the core holder? Okay, let's look at the core holder. If the share price increases to 80, so the core with a strike, so it will be 80 minus 50. That's the strike price for the core. 80 minus 50. Then the only thing which you are left with is the 4. Okay, actually I have an illustration here. And I'm just doing it straight from the head. That's not good. So 60 minus 3, 57. Profit is the spot price, which is 80, minus X, which is the strike 50, plus 4, which is equals to 26. So if you say 80 minus 50 minus 4, it gives you 20. So that's why I was saying 80 minus 50 minus 4 gives you 26. This is the last example, ladies and gentlemen, because people are burning. I'm known for, I went to see a client in Yumna, so to give people a bit of a break. And I was on the spreadsheet, I think we had a meeting from 9 to 12. I forgot to take a break. I was just going on and it was 11. The client was saying, please, John, can we stop?
Okay. So John, you can go through 3 hours.
I can still, because I've been studying for a long time, so I can go through lots of things. Okay, ladies and gentlemen, put core parity. The first thing before we do the example, I want to show you, this is what I call this a simplified formula. If you want to remember this, because remember you have no formula sheet in the Excel. Just remember this formula to say a call option is equal to a put option. A call option plus the present value. So C plus X divided by 1 plus R. This C is the call option premium. P is the put option premium. This is the spot price. This is the strike, the X to strike, divided 1 plus risk-free to the power of T, which is the time. So if you have this formula, you can solve any put call parity question you're going to come across. Okay, that's why the first thing before we do the question. So once we know that, then we are in business, life is going to be easy. So we come here and say a 9-month European put with a strike of 70 sells at a premium of 3 rand, which is a risk-free of 6%, and the current share price 68. Using the put call parity, calculate the equivalent value of the European call option. Using our formula, we're just going to take the information from here and put in our formula. So we are saying, what is C here? That's the thing we are trying to find. So C remains C. Plus, what is the strike price? Strike price we are given here 70, then we bring it here. Plus, 1 plus, what's the risk-free? 6%, put it here. What is the period? We are told that it matures it's a 9-month. So it matures in 9 months. 9 over 12. That's why we have 0.775 there. Otherwise, it was going to be to the power of 9 over 12. So if we do that, it becomes 3 plus or equals to 3. Where is the 3 coming from? Is the premium for the put. Our put premium is, because I'm told put with a strike of that premium, that is equal to 3 plus 68. What is the 68? That's the spot price. So we're putting everything in the formula. Once we do this, that's straight arithmetic, which you were taught from for a long time. You would know. So this whole thing jumps across the bridge to there. So if we say 70 divided by that, it gives us 67 point. Then it jumps across, then it becomes 3 plus 68 minus that gives you, ladies and gentlemen, that's yours. Last question, ladies and gentlemen, last question. Let's finish strong. Last question, this is yours. And I gave you the formula there to make life easy for you. Put call parity. Ladies and gentlemen, this is the last question. Before people collapse.
Not too difficult. We're working out the call option.
Yeah. This time it's still the call option. So it's just plugging the information from the top onto the formula. And make someone jump the bridge. And then if you get it right, then you are in business. If you get it wrong, even better, because then it shows you, it makes you even more ready to know what are you struggling with. And if you are not sure, ladies and gentlemen, if you are not sure, you can ask in the chat, or you can raise your hand and we can deal with it. And if you get stuck during the week, since we are not going to have a long closing speech, unless if Yumna wants to have a long closing speech.
No, we substituted the closing speech for derivatives.
For derivatives, yes. So because we were planning to have a 15-minute closing speech.
Yeah, no, people were going to ask us if they're proctoring the exam.
Yes,
and
yes.
what is it in invigilation, and that's not our expertise, unfortunately.
Yeah, because the owner of the subject is Mr. Matsoma. We are just the content people.
And Mr. Matsoma has put on, he's tried his best to put on lots of detailed information on the exam. Like in my previous experience, students had the right to ask, because very limited information was given, and things were not like, it wasn't taken on the exam portal and that. But in this time here, I feel like take your time, read what Mr. Matsoma has posted, and I would say even, okay, but I'm old school, print it out and just highlight certain areas of concern. And you can always send a message. He responds promptly as well. So yeah, he will give you all the information.
And also on the next week on the exam day, don't phone us or send us emails. We are completely out of the cycle. We send to exams if there's a problem.
Yes.
Because once we are done with the module, we are, me and Yumna, we are just having a good time and say, you know what, we did such a next. The exams are run by someone else. We don't even know what's happening there.
Yes, yes.
We'll be celebrating in the background.
Yes.
Okay.
We are.
Okay, looks like everyone is rooting for number one. And 100% people are really,
Well done.
that is really strong finish, ladies and gentlemen. Very strong finish. Okay.
You guys are going to be okay.
Yeah, and I'm so happy for this this lecture today, Yumna.
Yes.
Okay,
So
let me just quickly do it. So we are saying we are finding the core premium. So we are just pulling everything down. So we are saying the strike price is 100, 1 plus the risk-free is 5 to the power of, because it matures in 6 months. 0.5 equals to 3 is the put option, plus the spot price is 96. That's, we put everything there, 1.641. I'm not sure, Opa, if we can use Excel in the exam. Practice with your financial calculator. Because that property, I'm not sure how much, some of us would do, we finished this module when we were still writing in person. So technology has moved so fast, so far. Even you now is young, you also wrote in a physical paper.
yeah.
So we don't know how much the technology is checking, but practice using your financial calculator.
Yes.
Because the Excel is beautiful. Excel is beautiful because then you can then build in something, but then maybe you will be disqualified for no reason when you can use your financial calculator.
Yes. Yeah. I think it will be a bit of a risk. Eh?
Yeah, don't take that risk. Do you have any closing remarks to encourage the ladies and gentlemen for the exam?
No, I said it's always a pleasure teaching this module to you guys. And I hope that we've tried our best to prepare you as well as possible. And I wish you all the best and good luck for the exam. I know you're going to do really well. You've shown some real confidence in this lesson. Thank you. Enjoy the rest of your weekend. Happy studying.
Yeah, be ready, ladies. If you have a question there, ladies and gentlemen, ask in on my Unisa, and we'll be there to help.
Yes. I'll even put my email